Hey, Kyler here. Our aim for this show is to leverage every opportunity that life throws at us. I hope you find value in today's show.
Today, we're talking about the life insurance policy you did not know existed and needed. Once you hit a certain threshold, your basic term policy no longer covers the needs that you actually have in your life. I'm talking if you hit the 2.5 million to the 5 million threshold, this episode is for you on the Leverage Life Show. I'm Cord Offenbacher, joined with my brother and business partner, Kyler Offenbacher, hitting you with the life insurance coverage you did not realize you needed, but will actually be a game changer and will change the trajectory of your life because it will create a pool of tax-free liquid cash the moment your family needs it the most. So let's dive into something called premium financed life insurance, where we first have to break down what in the world the IRS is doing. They're changing the thresholds of how much a state exemption is necessary for a family. If you have 15 million as an individual or 30 million as a couple, anything above that in your family is going to be taxed at 40%. And most people don't realize if you're at 5 million or 10 million, you're probably going to hit that because now things are starting to compound. So what's going to happen the moment your family has a liquidity event? You need some tax-free liquid cash, and we want to decrease the barrier of entry with the life insurance policy you didn't realize you needed. Today on the Leverage Life Show.
Premium finance. Yep, Cord, you hit the nail on the head. It is probably one of the most strategic financial decisions a high net worth or ultra high net worth client could make that they don't know about, and most of their advisors are not aware of either. Because if you really look at the population this is meant for and who does it and the problems that it solves, it's really a small percentage of people that even qualify for this stuff. And so I think I've read that maybe 1% of the population even will qualify for it. But then even a subset of that, it's going to be, okay, who are the people that maybe they qualify for it, but it's actually going to solve a problem that they have. You know what I mean? So it gets kind of smaller, the more you filter down to it and funnel to these people that actually will benefit from something like premium finance. And if you are listening to this and you have a financial advisor, you have a CPA, then we definitely want you to open the conversation and just maybe ask them, hey, have you heard of this? I was listening to a couple brothers on YouTube and the podcast, and they're talking about this premium finance topic, and it's something that sounds really interesting. And I definitely encourage you to go ask them because I first of all, I'd be interested if they even know, because personally, I've met one person of all of the connections that I have here within my network of people that we're connected with that actually knew what premium finance was. And even that person, they weren't really 100% sure of the mechanics of actually how you get the thing done. So there's not a ton of advisors that you really know about this, number one, but then number two, they just didn't even know the mechanics and logistics of how to actually get it done and do it correctly, I should add too, because if you Google premium finance, you're going to see a lot of horror stories. I just want to put that out on the table here. And it's actually us just saying, hey, there's a lot of bad cases that have been done, and there's a lot of bad things that have come from this. But most of those, if not all of those, are because they were structured incorrectly. Hey, there are ways to structure this correctly, and that way you're doing it conservative, you're mitigating risk. But at the end of the day, you have to understand that there is risk involved with anything that you do. And this is one of those risks because you've got a lot of different players that are at the table to make sure this works correctly. And in a lot of ways, too, a lot of unknowns. I'm going to kind of dive into a little bit of that here in a second, but I want to just lay that out there of just saying, hey, if you Google this, you're probably going to see some horror stories, and it can kind of get a little messy. But I just want you to know that's a very small subset of people that are just doing it wrong. And there are plenty of people that are doing it right in the right ways. So let's dive into premium finance. So let's just go to the very, very basic bare bones of how I would describe premium finance to just a prospective client. Basically what I would tell them is hey, you need X amount for your life insurance policy, 20, 30, $40 million. Not going to get into the problems of why we would do that yet or the problems that solves, but saying you need a large amount of life insurance. All right. You've got really two options at place here. If you want a permanent policy, you can cut a check for the full amount out of pocket, that annual premium every year, or you could finance it. It's basically that simple. You're going to go and finance those premiums with a bank or a lender, and they are going to pay that premium on your behalf. Now, that's a very simplistic way to actually kind of like start the conversation with premium finance, but I think that's a good place to start, which is a very simple, basic way. And so when you have someone finance a policy, the client, you have to have skin in the game. I'll say that up front too. We never say that this is free insurance. That is not how this is marketed. Well, I should say maybe it is marketed that way and sold by some advisors that are doing it wrong. They will call it free insurance. It's not what it is. Okay. You have to have skin in the game. You've got to pay the annual interest on that loan that you're getting from a bank or some other lender. All right. So there's going to be some skin in the game on your behalf, but essentially you're going to have a massive life insurance policy. You've still got to do all the underwriting and all the things that you have to do to qualify for a life insurance policy, like with a carrier, like maybe Nationwide or Pacific Life, Symetra. There's a bunch of different carriers that will do this stuff. But you still got to go through the full process of that, right? You got to do that. But at the same time, we have to model up a strategy that actually says, hey, we're going to go to a bank and we're going to finance this policy, and the bank or the lender is going to pay the premiums to the life insurance company. Now, the client, like I said, you have to pay the annual interest out of pocket for that, but your outlay, if you will, for a 20, 30, $40 million policy, instead of that being 800, $800,000 million a year, like you'd be writing a check out of pocket, you're paying the interest on that loan, which is going to be significantly less. So maybe a couple $100,000, right? So now you can see the idea of where it frees up some cash flow that you can utilize in your business, that you can go reinvest in, or just kind of keep the ball rolling with your investments or your portfolio. But it still allows you to get a mass amount of coverage to solve certain problems I'm going to talk about here in a second. So that's a little bit more in the mechanics of how this actually works. And I will say too that this is a long game. The way I explain this to people is premium finance is kind of like marriage. It's similar to a mortgage, a mortgage on a house, but it's similar to marriage. It's meant for the long term. It's meant to be a great thing, a great financial tool. If you want to get out of it, it's going to cost you though. Okay. It's usually because you're going to have to, go through all the process of like getting rid of a loan, paying it off. Like there's a lot of like things like in that process if you want to get rid of it early. However, we always recommend like this is a long-term strategy. So when I say long-term, we're talking in decades. Okay. So these policies, we typically they have to be in force and let the cash value grow in these policies so that way we can exit the loan. But that's going to take a while. And so, it's not uncommon for anywhere from 12, 15, 20 years for the exit strategy to actually come to fruition, depending on what the exit strategy is to retire the loan specifically, because you've got to pay off the bank or the lender. Don't ever, let anybody tell you otherwise. You have to make sure that they are paid off. They are the one that is getting the loan to have this policy. So they've got to be paid back. That exit strategy is going to look different for different people. People will always say like, well, death is my exit strategy. Well, great. When you die, then the policy, you're going to have that mass amount of cash that's going to retire the loan. That is a very possible and feasible exit strategy, of course. But we want to have a more alternative exit strategy besides death. So, unless it's something that was catastrophic, obviously, that was unexpected, and that's kind of the point of life insurance to begin with. But if your exit strategy is truly to live long enough and then just pass away, that's not necessarily the exit strategy that we're looking for here. We have to look at what is a good exit strategy for the loan that you do have on this policy. And so let's dive into that a little bit more on an exit strategy perspective. So when inside of a large cash valued life insurance policy, typically we'll do an index universal life policy. Some people use a whole life policy for predictability. There's just some different mechanics of obviously how those things work. But with an IUL, we're going to let that cash value accumulate significantly in the policy. And that cash value over time is going to grow significantly to where that amount of cash value is actually more than the loan itself. that you have to actually have the policy. So there's going to be this crossover year, if you will, where it does overtake that loan balance. Now, you could basically take the cash value and say, hey, we're going to write a check and we're going to, pay off the loan from the bank, and the bank's gone. They're out of the picture, right? You could do that as soon as that threshold changes. What we like to do is to let that ride a little bit. We want to let that cash value
Mhm.
continue to accumulate and grow. That way, we're not just paying it right off the crossover year, but we're going to let that keep building. We want that to exponentially keep building year over year over year. And then eventually in the future, we're going to take that money, we're going to pay off the bank, right? But now you still have millions and millions of cash value in the policy that's going to continue to grow as well. And so there's lots of benefits and strategy, if you will, to actually getting this policy to not only the closing table, but actually making sure that it stays in force for how it's designed. And so there's lots of moving parts here, but like I said, to really just come back to the basics, if you will. It's basically having other people's money, OPM, if you will. A lot of investors will use that term in leverage situations. Is using other people's money to fund a very large life insurance policy.
Mhm.
Okay, so that is really at the core, bare bones of what it is. Now, the mechanics, everybody's situation is different. I want to make sure that is very clear. That this is a very customized strategy. Now, let's talk about some of the problems that this actually solves. Okay. So we always talk about, hey, we're not going to solve a problem that doesn't exist. We will always tell that to the people that we are looking at doing these policies with, or potential referral partners, whether that be like estate planning attorneys, financial advisors, wealth managers, CPAs, CFPs, those people. We're always going to tell them, look, we're not trying to steal that client relationship. Okay. These are your clients. We're coming alongside of you to make you the hero in the situation, of course, because you have that relationship. We're just the back office to get the thing done. Okay. So that's a big thing. If you are, maybe one of those people that does fall into those categories, I always want you to know that we're on your team. We're not trying to steal that relationship from you. Okay. That's just a little tidbit there. But to really go back into the problems that this solves, it's really just a couple different things. So one of them being historically the number one is going to be for estate tax liquidity. All right, Cord mentioned this earlier with somebody that becomes taxable. Now the current estate tax thresholds in 2026, the Big Beautiful Bill Act, they essentially said, hey, we're going to make this permanent right now. I don't think that anything's permanent in the government. That's just me, my opinion. I think it might depend on who's in office. I think laws can change and whatnot. But regardless, as of right now in 2026, the individual estate tax threshold is 15 million. For married couples, it's $30 million. Right. So
Mhm.
basically, that means if you have your estate that's underneath those thresholds, you don't have to worry about estate taxes when you pass away if you're under those thresholds. Now, if you have somebody that's maybe 40 years old, they're an investor, they own a business, and they've got maybe, a 5, 8, 10 million net worth, they have a longer horizon to build wealth. And so, you got to imagine, 25, 30 years down the road that they're probably, even if those thresholds are still in place, they're probably going to surpass those thresholds eventually. And so then they do become taxable. But what happens if laws change and those thresholds come down? They come down to 15 million for married. That's going to really open up the door for a lot more people that are actually going to be taxable, and they didn't really know or even have planned for that to begin with. So, what are the consequences of being taxable, if you will? So, that's a question we get a lot of times. And so, basically, if you're over those thresholds, the IRS is going to say, "Hey, you have an estate that's worth taxing, and so we want our cut. We want our fair share." Okay, so for all practical purposes, anything over those thresholds, you're going to hit with like a 40% estate tax bill. Okay, that's federal. Some states have individual state estate tax as well. So
Mhm.
don't forget that. It depends on your state, but federally, we're looking at like 40%. That's a lot. Okay, so if you've got, let's say for easy math, $10 million that's going to be over that threshold, that's going to be in that taxable estate, if you will. 40%, $4 million of that has to go to the IRS. And there's a timeline on that. So when you pass and you have to pay these estate taxes in 9 months, you've got to be able to have that
Mhm.
money to send to the IRS in 9 months. That could be problematic for people. And especially for people that have a lot of illiquid assets, that is going to be a big reason why doing premium finance is so valuable is because with a lot of illiquid assets, when the heirs inherit that and there's going to be an estate tax bill due, what is the family going to have to do? They're going to have to liquidate assets. So
Mhm.
rental properties, doors, businesses, whatever the asset is, if they don't have $4 million with my example to just cut a check to the IRS, they've got to liquidate assets to do that. So then now we're decreasing that generational wealth transfer kind of snowball effect. And so we don't want that for people. The wealth that you've built, we want that to pass on tax efficiently to your heirs and your people that are going to be, continuing on your legacy. And
Mm.
so if you had something like premium finance in place, now when you pass, you've got 20, 30, $40 million of liquid money that you can use to pay those estate taxes, to continue the business, to continue XYZ. Now you're in a much stronger position to actually, continue the wealth generation or the generational wealth transfer and the legacy, like I was talking about.
Mm.
So that's one specific reason, Cord, that we would do a premium finance case historically with estate tax, taxable people with estate tax exposure. Another great reason that people will do this is buy-sell agreements, funding buy-sell agreements for business partners. You've got a ton of businesses, and a lot of people will go into business together. And we've seen it done really well. We've also seen some really bad situations for business partners, and it doesn't work out, right? So that's a whole different story in itself, in and of itself. But anyways, business partners, you really need to have a buy-sell agreement in place. Now,
Mhm.
if you're not familiar with a buy-sell agreement, it's basically saying, hey, if something happens to my business partner, we need to be able to like essentially pay off that family. That way the business can continue to run in perpetuity. But it's really for that surviving business partner to not have to be married to
Mm.
the deceased business partner's family. So because a lot of times they probably may or may not want anything to do with the business. You don't want to have to be married to a business partner's family. And so that's where funding a buy-sell agreement comes into place. And so with for businesses that are crushing it and they need large amounts of buy-sell agreements because their valuation is large, et cetera, et cetera, funding that through a premium finance engagement is very, very powerful. And so there's lots of different ways you can structure that, of course.
Mm.
And even within an individual policy itself, that amount of money, that liquid money that you're getting, you can obviously, if you want to do this within a trust, and I'll talk about that a little more in a second, you can actually specify certain percentages of that to go to estate taxes, to go towards a buy-sell funding agreement. Okay. So you can be very creative and kill many birds with one stone to actually get something accomplished. So that's another problem that solves funding a buy-sell agreement. I'll give you two more quick examples, and then I'll go into the trust structures that we'll kind of see people do as well. But the two other ones is just basically generational wealth transfer. They know they want to have a great legacy and to continue the snowball effect of their wealth, and they know that their family is going to want to start businesses in the future. And so there's ways to basically reap the benefits of a large life insurance policy that way as well. So generational wealth transfer. If someone's young enough as well, like I was mentioning, maybe like a 35, 40-year-old, they have the time horizon to reap the benefits from the cash value. Tax-free retirement income can be a real strategy for them as well. And so we've done that for several people that we've modeled and strategized this with them.
Mhm.
We really will model it out and say, hey, at retirement age or whatever age that is, man, based on the cash value you have, you can actually draw from that and have tax-free retirement income from the policy itself. So now you're actually reaping the living benefits of having a life insurance policy because most people think about life insurance as like, of course, the death benefit, like it's going to be for the family, whatever that is. But there
Mm.
are actual living benefits that you can get as well from the cash value. So those are just some basic examples. Like I said, those last two. But Cord, really quick, let me go into the trust structure of a lot of times what people will do with this, and I'll hand it back to you to continue the conversation on this. But for a lot of people that are taxable specifically, they will have what's called an irrevocable life insurance trust, which is called an ILIT. And so we are not estate planning attorneys. We work alongside a lot of estate planning attorneys, but we're not the ones that actually write this. But we will help figure out, hey, what is the best strategy to kind of allocate this stuff as like the death benefit or the proceeds. But anyways, an ILIT is essentially it's a trust that owns a life insurance policy. So for this specific type of trust, it's an irrevocable trust. And so that means it's basically it's not yours. You don't own it, right? So when you have a life insurance policy, you could technically own the policy yourself, but basically what you're doing is you're putting that policy inside of an ILIT that you don't own. It's not yours anymore. It's part of the ILIT, an irrevocable trust. Now, what happens when you do that? It's very powerful. I want you to listen clear. Listen here. It takes the death benefit outside of your taxable estate. Okay. So 20, 30, $40 million. When you pass, that is not going to be subject to estate taxes. That's a very, very big thing for taxable people. Okay. You've got your estate, which is taxable, but the proceeds from the life insurance policy is not taxable from an estate perspective. That's very important. So you've got this money when you pass to go towards estate taxes. You should do that in ILIT probably. Okay. There's many other reasons you can do it for an ILIT. Some people own it within an LLC. Some people own it themselves personally. It just depends, just like anything else in finance. It just depends on your situation. So, but a lot of people will use an ILIT. That way it's outside of their taxable estate. And that way things are already taken care of. And you've basically already written out, hey, this is what this money's for. And it's a very, very powerful strategy. So, Cord, I just rambled on forever, so I'm going to throw it back to you to kind of continue the conversation. But you can see that we really enjoy this conversation about premium finance because it's such a powerful strategy that people don't know about. So I love the conversation, so I'll kick it back to you, Cord.
I know you do. I'll just make a quick mental note for all of our subscribers here. If you ever wonder if we know what we're talking about, Kyler just went for 20 straight minutes on
No
premium
way,
finance
that was
structure.
20 minutes. Look, everybody, let's just time out for a second. It's probably not going to come to a surprise to many people. Even if this is your first time hearing this conversation, it's not going to surprise you to hear me say that I'm a little bit of the nerd of the two of us. And so I like to take deep dives into subjects that are somewhat complex and, really understand everything from A to Z about it. Okay.
Mhm.
I think, and maybe too, just if you're somebody that wants to reach out about this, I I don't want to say that maybe it creates some trust, if you will, but you should work with somebody that knows what they're talking about. Okay, so I'll just throw it out there. But I am the nerd of the two of us. So, anyways, I didn't realize that was 20 minutes, so I apologize
No,
for
it was
that
it
being
was it
just
was awesome. So
uh,
funny. Well, let me give a practical example of somebody that we've worked with before, and then I'll land the plane and give you something to take with you as you listen to today's episode on the Leveraged Life show. So, when this really started to make sense, I was looking at a commercial real estate investor who's got about a $15 million net worth. And most of that cash was actually tied up in properties, which is the most common situation when you see a real estate investor or a business owner. All of their assets are tied up into business holdings or into rental properties, or in this case, industrial properties and multifamily properties. And what happens when you have an estate that's growing rapidly and it's all tied up into different assets like that, when there's a liquidity event, and that's a fancy way to describe, okay, somebody dies, a business is sold, and there's liquid cash that is needed to settle an estate. But the problem is this person's taxable and they owe a $4 million check to the IRS within 9 months after the primary breadwinner passes away. Okay, that's a problem. Where does that money come from? And that's a question we ask the people we're sitting across from. And most of the time, the wheels start to turn and some pieces start to fit together because they realize, oh no, the wealth I have spent a lifetime building and have invested into these different properties is about to have to be wholesaled at a discount just to write a check to Uncle Sam. And that is what we want to prevent at the very foremost. So that's why we start to put these structures into place and kill two birds with one stone. And what I mean by that is that person wanted to buy another investment property and he also needed this life insurance in place that he didn't know he needed at the time. So we were able to say, Why don't we accomplish both? Don't pick one or the other. You can get another investment property, and let's use your favorite thing called leverage, and we'll put it in place on this life insurance policy too. So instead of having to write that $500,000 check or $1 million check, you can write a $50,000 or $100,000 check and still get $15 to $20 million worth of life insurance. And in my experience, estate planning and wealth transfer is so much easier on everyone when there's some money involved, some liquid cash to help settle things. I guarantee you it just makes life so much easier. So that's one practical example. We could give you dozens, but I'll leave you with this, something that you could take with you today. If the worst of the worst happened, you died tomorrow, and I know that sounds morbid, what would happen to the estate, and will there need to be liquid cash present on hand that is needed, that is more than your term policy that's worth $1 million or $2 million? And yes, that term policy is great. We're the biggest advocates for term life insurance. But the average person we work with has outgrown their term coverage and does not know it. And they have not realized it yet. So this is why premium finance life insurance is an absolute superpower for your estate. And it's a life insurance coverage you didn't know you needed. So what we always say is it's always worth throwing the numbers on paper. You do it informally with our confidential informal inquiry. You're not applying for life insurance. We're just running your numbers. We're stress testing it and seeing if it even makes sense. Because premium finance, it's not a fit for everyone. But those smart investors who understand leverage and want something that can supercharge their estate planning for the long haul, I'm telling you, it's a game changer. If that's of interest to you to stress test some numbers, why not just shoot us a text? 479-396-3528. 479-396-3528. And just send us a message saying premium. Just send us a message saying premium to 479-396-3528. And if you found any value in today's episode on the Leverage Life Show and hearing Kyler riff for 20 minutes on premium financing, hit that like button and subscribe to our show because we have more awesome content coming every single Friday on life insurance, estate planning, wealth transfer, and making sure you leave a lasting legacy and leverage every single opportunity that life throws at you. We'll see you next Friday.